Hi, and a very warm welcome to each one of you to Franklin Templeton's Facebook Live session. We have been doing Facebook Live sessions along with Satish on varied topics like ELSS. Today we have with us Satish, who will be discussing his views and what next for mutual fund investors after the union budget announced a few days ago. Satish, a very warm welcome once again. Thank you so much for taking time out and making it for this Facebook Live session. Satish, let me begin this entire session by asking you, what do you think is different about this time's union budget vis-a-vis the budgets that we have seen in the last few years?
So there were three clear differences which were announced by the government, before they went into the union budget. One is, the preponement of the union budget. So everyone may have noticed that typically the union budgets were announced at the end of February. February 28th largely was earmarked for, the budget. And this year you've seen that the budget was announced on the 1st of February. So it was a 1 month preponement. Now why was this preponement done? So it was largely because you need some legislations to be passed so that the budget announcements can be implemented from the 1st of April, which is the new financial year. Right. So to give time for these legislations, the budget was preponed to the 1st of February. So this was one change. The second change was the merger of the railway budget with the union budget. So the railway budget usually is announced one day before the union budget. This time it was merged with the union budget. So if you notice that the railway budget also draws its finances from the union budget, and perhaps the government also may have realized that there's a lot of time and energy that goes into preparing the railway budget. So this was the second change. The third change was the merging of the plan and non-plan expenditure. So this was largely done because now the planning commission has been abolished, and you have the Niti Aayog which has come in place of the planning commission. You also don't have the 5-year plans,
right?
So the plan and the non-plan expenditure was relevant when these two entities were there. So this, and also you get a more holistic picture of expenses. So you have the plan and non-plan expenditure also being merged. So these were the three key changes that were there in the latest union budget.
And if you were to highlight, what are the key takeaways that this budget leaves us with? What's your view on that?
So in terms of takeaways, if you observe the media immediately after the budget, you would see that it was a very straightforward budget.
Right.
No big bang announcements, no populist measures. So it was pretty straightforward, fully focusing on, say, social spending, capital expenditure growth. So also on, say, job creation, digital economy, the building infrastructure. So these were the key focus areas for the government. Also a focus on fiscal health. So the finance minister announced that the fiscal deficit would be pegged at 3.2% for the current financial year, and at 3% of the GDP for the next 3 years. So this has also been a focus of the government to maintain financial health. So fiscal deficit is basically the gap between the income and expenditure of the government. So having said that, if you look at some of the announcements that were made, one focus was clearly on job creation, and job creation at the grassroots level.
Right.
So the finance minister made one big announcement that the micro and small and medium enterprise segment, which is called the MSME, the corporate tax rate for that segment was reduced from 30 to 25%. So which is a big enough incentive for this sector, to create jobs and grow. So he also quoted some numbers. So if you look at, if you have heard the budget speech, the finance minister said that there are about 7 lakh companies which file, their returns, And out of these 7 lakh companies, about 6.7 lakh companies fall into the MSME segment. So that's around 96% of all companies. So if this is, a big chunk, then giving them that incentive of 30, tax, reduction in tax from 30 to 25%, it's surely a big incentive. The budget also looked at taking the demonetization agenda forward, and there were some announcements on how the cash economy can be curbed. So there were some announcements on those front, and also on the personal tax front, what the finance minister did was slashed the tax rate for the lowest income segment, which is the 2.5 lakh to 5 lakh segment, from 10% to 5%. And he also gave the benefit of that 12,500 tax benefit. He also gave that same benefit of 12,500 to subsequent tax slabs. So so this was the reduction. He also added a 10% surcharge to the income slabs of 50 lakhs to a crore. So here he has added a 10% surcharge. So these were some of the key announcements that came from the finance minister.
Satish, is it good to assume that the reduction in tax rate is in a bid to improve the tax compliance and widen the number of people who start paying their taxes?
Certainly. In fact, the finance minister highlighted that tax compliance is certainly an issue in India, and the government is making its efforts to improve tax compliance. And one way of doing that is to bring down the tax rate. So if you look at the lowest tax slab now, it will pay a 5% tax, which is very, very marginal. So if you reduce the tax rate, the government feels that more and more people will come forward and pay their taxes. So having said that, he quoted the number of tax SSCs, which is around 3.7 crore, and out of which 3 crore, almost 3 crore fall in the less than 5 lakh bracket. If such a large quantum of SSCs fall in the less than 5 lakhs bracket, it's certainly a good incentive to reduce that tax slab from the tax rate from 10% to 5%. But he was also concerned that there were about 1.25 crore Indians who bought cars in the last 5 years, and about 2 crore Indians went abroad, both for leisure or business, in 2015. But he feels that the numbers don't add up. If you look at people buying cars and people going overseas, he feels that the number of taxpayers has certainly to be better than what it is now. So the rates coming down looks apparent that the government wants more and more people to come forward and pay taxes.
Satish, we have a lot of people who are watching this Facebook live session, and they could be existing investors of Franklin Templeton or prospective investors who may be looking to make investments. How do you think that this budget impacts a person from an investment perspective?
So if you had followed the market when the budgets were announced, there was a good amount of cheer in the market. So prior to the budget, there was some anticipation, that the long-term capital gains period for equities, which is currently 1 year, may be increased to 3 years. So the markets were waiting for the budget and what will come out in the budget. But ultimately, this announcement did not happen, and that helped the market rally immediately after the budget. So this was one factor that brought a good amount of cheer for the market. Among other announcements from an investment perspective, one was the phasing out of RGESS, which is the Rajiv Gandhi Equity Saving Scheme. So this scheme was launched largely to incentivize first time equity investors, and they were given a tax incentive for parking their money in equity funds. And but probably this scheme has got a lukewarm response, and the government announced in the budget that the Rajiv Gandhi equity savings scheme would be phased out. The second announcement was on the NPS front, which is the National Pension System, and the government said that 25% of the employee's contribution can be withdrawn before the age of 60, and this withdrawal will be tax free. So this was one cheer for NPS investors. And the third announcement from an investment perspective was where the finance minister said that the long term capital gains period for real estate has been reduced from 3 years to 2 years. So this is I believe a good incentive for people who want to sell off their real estate maybe earlier than 3 years. And he also changed the base rate for claiming indexation benefits, which is wherein you get inflation, you can adjust the cost for inflation. So the indexation, the base year basically for indexation was changed from April 1, 1981 to the 1st of April 2001. So these were largely the announcements from an investment perspective, and as I said earlier, there was a big thrust on infrastructure. Affordable housing was accorded an infrastructure status, and the allocation for the infrastructure sector was as high as 4 lakh crore. So these largely sum up some of the key announcements from an investment perspective.
Sure. Satish, one of the things that all of us as Indians would kind of always remember, last year November 8th, 2016 is a day that none of us will forget. I personally remember I was driving back late in the evening, and there was a flurry of WhatsApp and phone calls, and by the time I reached home, it was all over the news, and this word demonetization was out there for all of us, right? How do you think that the finance minister within the union budget has actually taken forward the agenda and the theme of demonetization for the country?
So clearly it was expected that there would be announcements to take forward the agenda of demonetization, and clearly the finance minister is looking at less cash in the economy. So the first big announcement that he has made is that any transaction which is of a cash nature, and you have to restrict that transaction to less than 3 lakhs. So any cash transaction above 3 lakhs would not be allowed. So that is one. The second is where he talks about the expenditure, the expenses that are claimed by companies. So a single transaction which is 20,000 up to 20,000 rupees in cash was the earlier limit. That limit has now been slashed to 10,000 rupees.
Right.
Thirdly, if you look at charitable donations, so there the cash limits have been capped at 2,000 rupees. So you can only give a cash donation of 2,000, and anything above that has to be in a bank transaction, either online or through a check, and only then will you be able to get a tax benefit. So if you want to claim a section 80G benefit, then you'll necessarily have to give that donation in through a banking channel if the donation is more than 2,000 rupees and you want to claim that 80G benefit. The finance minister also spoke about transparency in election funding, and apparently there's a lot of cash that moves around in election funding, and he has proposed to introduce electoral bonds. So we need to get further clarity on that, but that was one big announcement in terms of bringing transparency within electoral funding. So I think these measures clearly add up to say, propel the digital economy and also help to take forward the demonetization agenda of the government.
Right. Satish, investors have now started believing that the kind of returns that a fixed guaranteed or an assured product is offering no longer are that interesting or exciting to them. How do you think mutual funds step in, and how can investors think beyond the typical traditional investments they're looking at?
So you're right when you say that your traditional investments or assured returns products, the returns have come down.
Right.
And if you look at history, in the 90s, people were getting double-digit returns from assured returns, and you were not required to look at alternative avenues. But when you look at the returns from these products today, certainly people are looking at alternative avenues, and mutual funds is one of the choices that is being explored. So if I need to explain this, I would say that mutual funds certainly provide a good amount of variety in terms of debt products. To give you an example, say for example, there are liquid funds, which are at the lowest end of the risk spectrum. So if you look at products across the risk spectrum, and you can invest in various debt products depending upon their risk appetite and investment horizon. So if you look, so liquid funds are short-term products. You can invest in them for a less than 3-month investment horizon. You can park your contingency funds in them. You can park some of the money that you have in your savings bank account, money that you need over a very short period. So these are some of the products that can help. There are products like accrual funds, which help to provide more stable returns, and you can park your money for even the medium term. So besides variety, mutual funds offer convenience. There is a lot of transparency. There is good amount of regulatory regulations that support mutual funds. And having said that, even if debt funds were giving the same returns as assured returns products, you would find that if you look at tax efficiency of mutual funds and look at investment horizons which are beyond 3 years, you will notice that for the same amount of returns, mutual funds would be more tax efficient, because one is you get to claim indexation benefits, which is nothing but inflation adjustment. So for example, if mutual funds are returning 10% and inflation over that period has been 5%, you pay tax only on the remaining 5%. But if you look at your traditional products, you need to pay tax on the interest that you earn every year.
Right.
You have to, whether you redeem it or no, you have to pay tax on all the interest. You have to add that interest to your income and pay the tax.
Absolutely.
And you pay it at your tax slab. So if you are in a 30% bracket, you pay tax at that rate. But coming to mutual funds, if you hold it for a more than 3-year period, you get the benefit of long-term capital gains and indexation benefits. So long-term capital gains are 20%. Of course, you'll have the applicable surcharge and cess, but which is lesser definitely than the highest tax slab. So if you look at it from a holistic perspective, there is definitely merit in looking at debt mutual funds.
Right. Satish, there is obviously, and investors are aware, there is an upside that you can get when you invest in an equity fund, but there is also a downside, and that's the main fear that most investors have. What do you think? Is there a way where an investor can get best of both the worlds? Is that possible?
So you're right. A big impediment when you look at equity investing is the downside. And people fear that if I put my money in equities, I may lose some bit of that money. That's why you find that most of the savings of Indians is parked in traditional products. If you look at FDs, you have more than 100 crore of savings which are parked in bank deposits. So, but if you want to invest in equity mutual funds and also take part or participate in the upside potential of equities, clearly you need to have a long-term investment horizon. You cannot invest in equities for the short term.
Right.
So you need to have a long-term investment horizon. So the minimum I would say should be at least 5 years. So more the merrier. So you could have 10, 15, 20 years. Secondly, you need to be regular in your investments. You can use one of the avenues called SIP or systematic investment plans,
right,
which helps you invest regularly. So if you invest regularly, what happens is that you ride over that that volatile phase.
Right.
So it provides you the benefit of something called as rupee cost averaging. So what happens here is that you buy more units when the markets are low, you buy less units when the markets are high. This is exactly what you want equities to do. Basically,
Right.
you want to buy equities when they are available cheap. You want to sell equities when they are at the peak.
Right.
But it's very difficult to time the market. So SIPs help you to ride that volatility and invest over the long run, and pick up those units at different phases of the market. And you also get the benefit of compounding because of
Right.
the longer period. So besides this, equity funds offer tax efficiencies. So you have long-term capital gains after 1 year. So the returns are tax-free.
Right.
Dividend is completely tax-free when it comes to equity-oriented funds. So these are some of the key aspects that investors need to keep in mind when they look at equity investments. So the message for investors here would be that time in the market is more important than timing the market. So you have to be in the market for a
Right.
longer period,
Absolutely.
then look at timing the market.
I think I really like this, that it's not about trying to time the market, but it's about the time in the market that
Absolutely.
you spend in order to benefit from what you just said. So Satish, I think we have really had some interesting questions and all your views coming. If I could just ask you to leave us with a few concluding remarks from your side on this theme, what would that be?
So since we are talking about the budget, I would say that people should look at the budget as a one-off event,
Right.
because there are various events that could impact investments, impact markets. So budget should be a one-off event because it anyway happens every year. Investments should be more strategic, more aligned to your goals, more long-term.
Right.
Okay. Don't change your investments just because there's a budget announcement. You could make tactical changes which are not very it's very small in nature, but don't make any large changes to your investment and look at it from a strategic perspective. A budget can only be take tactical calls. For example, if you are looking at say a 10-year product and you invest say based on the budget, you will realize that the tax changes that happen over this 10-year period is you will be not able to forecast those changes.
Right.
So hence I would say that look at the budget from as an event, if possible, if you want to make any tactical changes, fair, but don't change your investments strategically. Let them be there. Look at it from a long term perspective. Believe in investment planning being coming before tax planning.
Right.
So that's largely the message that I would like to leave the investors with.
Absolutely, Satish. Thank you so much once again for taking time out and being with us, sharing your views with all our users who are watching us at this point of time. Thank you so much once again to each one of you for logging into this Facebook live session, spending time with us, seeing what views we have Satish sharing with us. Stay tuned with Franklin Templeton on our social media properties, because we do intend to bring out more such webinars and Facebook live sessions and much more interesting content with you. So keep following us on our social media property. And once again, thank you so much for joining us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.